Welcome to the Deep Dive. We take your sources, we dig in, and we pull out the key insights for you. Today, we're tackling a real giant. Procter Gamble, we've got a stack of material here, articles, notes, financials. Our mission, to unpack this consumer empire, figure out its core, and find those surprising takeaways for you. So, starting right at the beginning, it's not what you might expect, is it?
No, not at all. P&G kicked off in 1837. And get this, it was right in the middle of an economic panic.
Wow, okay.
Yeah, William Procter, he made candles, and James Gamble made soap. Complete strangers, except they married sisters, and it was actually their father-in-law, Alexander Norris, who persuaded them to go into business together.
Huh. So that family link, born out of crisis, that must have baked something into the company culture from day one, right? Resilience, maybe?
I think so. It really seems to have set a foundation for adaptability.
Yeah.
And you see how that played out pretty quickly. Their early success got a massive boost from Civil War contracts with the Union Army.
Right, that would get their name out there.
Exactly. It basically introduced P&G products all across the nation, and they were innovating, too. Think Ivory soap, the one that floated. That was them.
Oh, yeah, I remember that.
And even way back in 1887, they started a profit-sharing program for employees. Pretty forward-thinking for the time.
That really does speak to a long-term view. Does that sort of thinking carry through to today, like in how they run the company now?
Well, look at their board. It's quite diverse. You've got execs from places like McDonald's, Disney, bringing different viewpoints.
Okay.
And they do adapt. Remember that proxy battle in 2018 with Nelson Peltz, the activist investor?
Vaguely.
Well, he actually ended up getting a board seat. It showed, P&G was willing to engage, maybe even bend a little when shareholders pushed.
So this history of resilience and adapting, how does that translate into the numbers? Are they financially solid?
Oh, absolutely. If you look at the last decade, say 2015 to 2025, their price total return is over 168%. Pretty compelling.
That's strong.
And revenue's grown consistently. They're looking at, $84.3 billion by 2025? But there's a key point here, something you might see in the figures.
Yeah.
Fiscal year 2019. You'll see a big dip in operating and net income. Now, you might think, uh-oh, trouble.
Right. That looks bad on the surface.
But it wasn't really about the core business failing. It was mostly a non-cash impairment charge related to the Gillette brand. Basically an accounting adjustment.
Writing down the value of an asset.
Precisely. It cleared the deck strategically. What you should focus on is their operational health. They generated nearly $18 billion in operating cash flow in FY25. And they consistently return cash to shareholders, over $16 billion that year.
So it's crucial to look past that one accounting hit and see the underlying strength.
Exactly. It shows smart financial management, playing the long game.
Okay, so financially strong. How do they actually operate in the market? What's the strategy with all those brands they own?
They run what's called a house of brands model, 5 main segments. The biggest is fabric and home care. Think Tide, Febreze, those household names.
Got it. And where do they focus their efforts geographically?
That's interesting. P&G gets almost 2/3 of its revenue from stable developed markets, North America, Europe.
How does that stack up against rivals like Unilever?
It's quite different, actually. Unilever leans more into emerging markets, faster growing ones. P&G's strategy really emphasizes predictable cash flow over maybe chasing that higher but potentially riskier growth elsewhere.
So that stability focus. How does the stock market view that? Does the stock price reflect it?
Well, this brings in Benjamin Graham's idea of Mr. Market, right? The market can be moody. But P&G's stock, it's generally trended up, hitting an all-time high around $180 late in 2024.
Right.
And its beta is exceptionally low, 0.16, which basically confirms it's a defensive stock.
Meaning it doesn't swing wildly with the market?
Much less so, yeah. It offers stability in volatile times. But even defensive stocks aren't immune to everything. Their guidance for FY26, for example, mentioned a $1 billion headwind just from tariff policies, so external factors still matter.
Stability is great, but no company's perfect. Have there been challenges, missteps?
Definitely. History shows that. You had the toxic shock syndrome issue back in 1980 with Raleigh tampons. That led to a voluntary recall, a really significant moment for them in terms of product safety and public trust.
A major test.
For sure. And more recently, there's a 2025 class action lawsuit. It alleges greenwashing related to Charmin toilet paper.
Greenwashing.
Yeah, the claim is about misleading marketing the Keep Forests as Forests slogan, while allegedly sourcing from Canada's old-growth boreal forest and misrepresenting their FSC certification.
Okay, so allegations of misleading environmental claims, we're just noting what the sources state here.
Exactly, just reporting the claims outlined in the materials.
So bringing it all together, if we look at P&G through, say, a Benjamin Graham value investing lens,
Yeah.
how does it stack up?
Graham loved a margin of safety, buying a good company at a bargain price. P&G definitely looks like a fit for his defensive investor. It's stable, huge dividend history, 135 years without interruption.
That's incredible.
It is. Qualitatively, it ticks a lot of boxes. Size, financial strength, dividends. But on Graham's strict valuation criteria, it currently falls short. Things like the price-to-earnings ratio, price-to-book, they're just too high right now to offer that significant discount, that margin of safety that a deep value investor hunts for.
Okay, so let's distill this. What's the takeaway for you listening? We've seen P&G is, well, a beast. Financially powerful, incredible history, super stable, defensive, loves giving cash back to shareholders. A true giant.
No doubt about it. But as this deep dive shows, the stock itself, where it's trading now, it doesn't scream bargain in that classic value investing sense.
Right.
It's a quality company, absolutely. But Mr. Market seems to be charging full price, maybe even a premium for that quality.
Which leaves you with a really interesting question, doesn't it? When you analyze a company like P&G, how do you balance that undeniable long-term stability and income stream against maybe finding a deeper discount elsewhere or perhaps faster growth potential? Is the goal always the absolute lowest price? Or is there real value in paying a fair price for, well, premium, reliable quality? Something for you to chew on as you do your own deep dives.